48 hours. That's all the time left before Jerome Powell announces the Federal Reserve's final decision of 2025, December 10, 2025, 2 p.m. Eastern. The most anticipated Fed meeting of the year. Markets are pricing in an 87% probability of a 25 basis point rate cut, bringing the Fed funds rate down to 3.5 to 3.75%. Think about that for a second. But here's what nobody is telling you. The Fed is making this decision completely blind. The October jobs report? Canceled. The October inflation report? Canceled. The November jobs report, which was supposed to be released December 5th, 5 days before the meeting? Delayed until December 16th, 6 days after the vote. The November inflation report? Delayed until December 18th, 8 days after the decision. The Fed will walk into the most critical monetary policy meeting of 2025 with only September data. That's 90 days old. 3 months of darkness, zero visibility. And to make it worse, 5 out of the 12 voting members of the Federal Open Market Committee are now openly opposed to any further rate cuts. That's unprecedented dissent. The Fed is split. The data is missing. And in 48 hours, Powell must decide the fate of the U.S. economy with blind eyes and divided votes. Wall Street analysts are calling this the most dangerous Fed meeting of the year. BMO Capital's deputy chief economist said, the Fed will be flying even more blind than it was last month. Wells Fargo said the FOMC appears unusually split. And the mechanism behind this data blackout reveals why December 10th isn't a rate cut. It's a coin flip with trillion-dollar consequences. Let's start with the odds. Because 87% sounds confident, but underneath, it's chaos. According to the CME FedWatch tool, markets are pricing in an 87% probability of a 25 basis point cut at the December 10th to 11th FOMC meeting. This would lower the target range from the current 3.75 to 4% down to 3.5 to 3.75%. Only 13% chance of no change. Less than 1% chance of a larger cut or hike. Those odds have fluctuated wildly over the past month. In mid-November, they dipped to 30 to 35% after stronger than expected September jobs data finally came out and inflation concerns resurfaced. The S&P 500 dropped 2 to 3%. Treasury yields spiked. Markets thought the Fed would hold rates steady. But then New York Fed President John Williams gave his near-term speech on November 21st. Using that phrase 3 times to signal a rate cut was imminent. Within 48 hours, odds jumped from 35% to over 70%. Then Governor Chris Waller said the declining labor market is his priority, not inflation. Odds climbed to 85%. Then the September PPI inflation report showed core PPI lower than expected. Odds hit 87%, so markets are confident. 87%. But that confidence is based on one assumption: that the labor market is weakening and needs support. Except nobody actually knows if the labor market is weakening because the data doesn't exist. But the chart I am about to show you reveals the catastrophic data blackout that's forcing the Fed to guess. Because here's what the Fed doesn't have. The October jobs report was officially canceled on November 19th. The Bureau of Labor Statistics announced there will be no employment situation report for October. The household survey data is not able to be retroactively collected due to the 43-day government shutdown that lasted from October 1st to November 12th. That means there's no October unemployment rate, no October labor force participation rate, no October household employment data. It's gone forever. The establishment survey data, which tracks business payrolls, will be lumped into the November report. But the household survey, which determines the unemployment rate, erased from history. The October inflation report was also canceled. The BLS said the consumer price index for October is not expected to be published because the government shutdown prevented real-time data collection. So there's no October CPI, no October core inflation, nothing. Now the November jobs report, originally scheduled for December 5th, has been delayed to December 16th. That's 6 days after the Fed meeting. The Fed will vote on Wednesday, December 10th. The jobs report comes out Monday, December 16th. Powell must decide before he sees the data. The November inflation report, originally scheduled for December 10th, the exact day of the Fed announcement, has been delayed to December 18th, 8 days after the decision. The Fed won't know if inflation accelerated, decelerated, or held steady in November until a full week after they vote. So here's what the Fed has. September jobs report, released November 20th after a 7-week delay. It showed 119,000 jobs added, below expectations. Unemployment rose to 4.4%, triggering the SAM rule recession indicator. September CPI, showing headline inflation at 2.4% and core at 3.3%. September PPI, showing core PPI lower than expected. That's it, September data, 90 days old. And based on that stale information, the Fed must decide whether to cut rates for the third time in 2025. Michael Gregory, deputy chief economist at BMO Capital, said, the Fed will be flying even more blind than it was last month. They'll have to rely on weekly state jobless claims, private payrolls reports from a DP, or anecdotal evidence from the Fed's Beige Book. Translation: the Fed is guessing, with trillion-dollar consequences. Now let's talk about the split. Because even if the Fed had perfect data, they're divided like never before. Reuters reported that 5 out of the 12 voting members of the FOMC are now openly opposed to any further rate cuts. That's unprecedented. In modern Fed history, you rarely see more than 1 or 2 dissents. 5 out of 12 means the Fed is deeply fractured. Wells Fargo said the FOMC appears unusually split, yet there seems to be critical mass support for the dovish faction. They predict multiple dissenting opinions at the December meeting. The 2026 median dot plot, which shows where Fed officials think rates will be next year, is expected to remain at 3.375%. But Powell is likely to hint at a higher threshold for additional cuts, suggesting a potential hold in January. Translation: the Fed might cut in December, but they're signaling no more cuts after that. This is the last one. And half the committee doesn't even want this one. Why the split? Because the hawks see inflation. Core PCE, the Fed's preferred measure, is still at 2.8%, well above the 2% target. Wage growth is at 3.8% year over year. Services inflation is sticky. And tariffs, if Trump implements his proposed policies, could add another 1 to 2 percentage points to inflation in 2026. Fed Governor Austan Goolsbee said, I am somewhat hesitant about implementing too many rate cuts too soon, relying on inflation to diminish on its own. He wants to see actual evidence that inflation is falling before cutting more. But the doves see a collapsing labor market. The September unemployment rate of 4.4% triggered the SAM rule. ADP reported that private employers shed 32,000 jobs in November. Weekly jobless claims have been rising. Temporary help services, the canary in the coal mine, are at the lowest level since 2012. Fed Governor Stephen Miran said today that the U.S. economy requires more significant cuts. He's advocating for 5 additional cuts, including potentially larger reductions. He wants to cut aggressively to prevent recession. So you have 5 members who want to hold or raise rates to fight inflation. And you have the other 7 who want to cut rates to support the labor market. The Fed is at war with itself. And they're making this decision with 90-day-old data. But here's the death spiral scenario. The Fed cuts 25 basis points on December 10th, based on September as weak jobs data. Markets rally, stocks surge. The S&P 500 hits new all-time highs. Bitcoin breaks through $100,000. Everyone celebrates. The Fed saved the economy. Then, on December 16th, the November jobs report drops. And it shows the labor market is much stronger than September suggested. Payrolls surged 200,000 in November. The unemployment rate fell back to 4.2%. Wage growth accelerated to 4%. The SAM rule was a false positive caused by immigration expanding the labor force, not actual job losses. The Fed just cut rates based on weak September data. But November shows the economy doesn't need stimulus. The Fed made a mistake. They cut too much. Inflation expectations spike. Bond yields explode. The 10-year Treasury surges from 4.2% to 4.6%. Mortgage rates hit 8%. The housing market collapses. Stocks crash as investors realize the Fed is behind the curve again, just like 2021 when they called inflation transitory. Alternatively, December 16th arrives, and the November jobs report shows catastrophe. Payrolls fell 50,000, unemployment spiked to 4.8%. The SAM rule wasn't a false positive, it was an early warning. The recession is already here. The Fed cut 25 basis points, but they needed to cut 50. They're too late. Markets crash because the Fed can't stop the downturn. Either way, the Fed loses. If the data comes in strong, they cut too much and fuel inflation. If the data comes in weak, they cut too little and fail to prevent recession. And they won't know which scenario is real until after they vote. So here's the 48-hour countdown. December 10th, 2025, 2 p.m. Eastern. Jerome Powell announces the Fed's decision. 87% odds of a 25 basis point cut to 3.5 to 3.75%. But the Fed has only September data, 90 days old. October jobs report, cancelled. October CPI, cancelled. November jobs report, delayed until December 16th. November CPI, delayed until December 18th. 5 out of 12 voting members openly oppose further cuts. The Fed is unusually split. The most divided in modern history. BMO Capital, the Fed will be flying even more blind than last month. Wells Fargo, critical mass support for dovish faction but multiple dissents expected. Wall Street, this is the most dangerous Fed meeting of the year. 48 hours until Powell flips a coin. Heads, inflation reignites and the bond market rebels. Tails, recession accelerates and the Fed is powerless to stop it. Either way, the market crashes when the November data finally arrives 6 to 8 days too late. Are you watching the show, or are you positioned for the Fed's blind gamble in 48 hours? What do you think? Drop your answer in the comments below.